Hi everybody, and welcome along to the Mint Monthly Update for the single sector funds. Today you've got myself, David Fyfe, and fellow portfolio manager John Middleton talking through the month of December, and I guess both the year and the month that was. We hope everyone had a good break. In terms of markets, it's been an interesting year. It's been an interesting month as well, but as it's quieting down in December, I thought we'd just touch briefly on the year that's been. Obviously, from an offshore market, it's been very dramatic. We've seen some big moves. I guess anywhere from pretty resilient economic growth throughout a lot of the world, maybe less so in New Zealand. Certainly seen inflation cooling right off, and that's sort of reset to more normal levels. Seen some pretty strong earnings numbers, especially out of the US. And I guess that's why I've sort of included the charts below, just to sort of touch on what has been a key theme, which has been the divergence within some of the global markets around tech. As you can see on the right-hand side, in terms of earnings drivers in the last few years, tech has been absolutely head and shoulders above the rest, both in terms of volatility, but also level of growth, as you can see. And then on the left there, you can see, while the markets have bounced heavily in terms of earnings, it's sort of nowhere near the same tick up. So we have seen multiple expansion as well, which is always one of the key drivers of what happens for the year ahead. Bringing it a little bit closer to home in terms of New Zealand, it's been an interesting year. It's been a good year. The New Zealand market finished up 11.4% for the year, with that little 0.4 coming in December, of course. So it's a small, just above positive return for December. But in terms of what happened in New Zealand for the year, I've sort of thought I'd throw a wee chart there to show you what sort of contributed in terms of earners. Now, and it was a bit of a mix, but again, unsurprisingly, it was the large caps that outperformed sort of over 12% in terms of the weighted return. The other end of the town, small caps, about -10, so a bit of a divergence there. And actually, when you do break up the market, we look through, there's about 17 stocks, so it's more than a third of the market, actually returned above 20%. So there's certainly been some sort of good names to pick throughout the year. So it's certainly a stock picker's market. In terms of the sectors that did well, obviously healthcare through Fisher & Paykel Healthcare had a storming year, up over 60%. As they continue to recover from their post-COVID, but also can do pretty well with their new products in general. But also tech was a very strong performer, whether it's Gentrack through its growth and recovery as it does well globally, but also Vista with a bid that certainly saw that do well. And then the other large caps, Contact, Infratil and Somerset all did very well over the year in terms of falling within favour. The other end of town, retail, unsurprisingly, it's had a very challenged year. Whether it's been through lack of consumer demand or inflation pressures and wage pressures, Kathmandu Warehouse, even THL on the consumer front has had a very challenged year. The biggest surprise is probably around Spark in terms of the large caps underperforming. Certainly has had a brutal year from, we've seen dividend cuts, we've seen earnings misses, and we've also seen a sort of challenged government coming in terms of cutting a lot of the products that they have with Spark, and that's certainly hit them pretty hard. So it's been a tough one. In terms of the month of December itself, a little bit less volatile than that. We saw strong movement out of Auckland Airport. That was posted sell down to the council stake, roughly 10% of shares on issue. There's a lot of interest in offshores and increased index weight, which certainly saw that bounce into the year end. In terms of other names, it did provide an update over the month of December. Scales provided their FY25 guidance. In terms of underlying impact, came in a little bit below some expectations, but at the end of the day, it is a +15 underlying earnings growth. So it's not a bad year ahead for Scales. Where was there a slight miss? It was around their global proteins business. Not really a big one, just in terms of timing. It's just some of the recovery a bit slower than expected. But again, they've still stuck to their 70 million EBITDA target for FY27, and we think they can certainly make that, which makes it a pretty attractive position and one we continue to hold in the fund. Additionally, their horticulture business is doing well post the Bostock and Craigmore transactions. With more premium fruit and prices holding up, we'll look to see if they have a good harvest in the next couple of months, and hopefully a good year for Scales. The other end of town, we saw Spark selling the tail end of their towers business to some Canadians. Also, I myself made a trip down to Taupō to visit Contact's geothermal sites. Really, really interesting to see all those different geothermal assets, whether it's the latest one, Tahara, which has now been commissioned. I've had some major issues with steam separation that's now been resolved. We got to have a wee good look at what happened there, but also their new Te Huka plant as well, 50 megawatt site that's come on board and running as of this quarter. And then also having a look at Wairakei, which is the old 1958 station that's being somewhat decommissioned over time, but being extended as well as they bring on their Te Mihi too. So lots of action in the geothermal fields down there, and contact right at the forefront there. So, very, very good and very supportive of the renewable market in New Zealand. Also Manawa, the transaction with Contact, there was expected decision on Christmas Eve. Wisely, that was pushed back to this quarter as they still work out over the decisions. But in our view, we still think that will happen and continue to hold Contact within the portfolio. One of the other names that had a big update was Serco. They held a investor day in mid-December, sort of walking through their plans around in terms of how they grow the business. They've sort of had a slower than expected start for some people from the booking.com business around unmanaged travel. But this was an opportunity they took to show us the talent of people within the business. Also their plans around developing product with Booking, but also their Get There business they transacted recently, which is largely in North America. Nice to see a bit of diversification away from that Booking relationship. But also, some guide around the 250 million revenue target they've set for 2030 and how they plan to get there with a little bit extra cost. But also they gave some rough targets that actually show that it could be quite cash flow positive by then as well. So we remain positive of that name and continue to hold in the fund and think it continue to do well from there. In terms of the fund itself, new name in Napier Port. We quite like the defensive asset. We quite like its recovery in earnings and also the value it's trading at. So it's one that we continue to support. And at the other end of town, we exited some of our REIT holdings in KPG. So I'll now pass over to John for the Trans-Tasman Fund.
Thanks, Dave. The Australasian Equities Fund had a solid performance for the month, up about 20 bips, broadly in line with the index. I suppose the chart on the right is sort of what I wanted to flag, is that while New Zealand, it was in slightly positive territory, the rest of the world was under a little bit of pressure, and the Aussie index fell about 3% in December, akin to some other markets. Why was that? Well, a couple of things. I mean, basically macro driven. Obviously, there are mounting concerns about rates remaining high for longer, and Australia is probably towards the back end of the rate cycle versus others expected to cut in 2025 versus 2024. But we also got a bit of Australian data. The GDP print was weak, which was actually relatively good for if you want rates to be cut. But the unemployment print was particularly strong and ahead of expectations, and that raised concerns that Aussie rates aren't going to be cut anytime soon. In terms of the month, in terms of news flow, I think Dave summed up most of the New Zealand side of things. It was very quiet in terms of news flow in Australia. A bit of capital raises on the mining side of things, but very little else. The real focus was the macro. Obviously, we started talking about tariffs and what Trump might do globally. And again, Australia, it's less of a trading partner with the United States, but clearly a trading partner with China. And I think there were concerns manifesting there, particularly on the commodity side of the market. So, a weaker month in Aussie, but again, a solid performance from the fund. In terms of what we did during the month, well, we participated in the Auckland Airport sell down and actually bought a little bit of Mercury and Spark on weakness, those two associated with index changes with a reasonable amount of selling in the market. So we sort of picked some up on attractive valuations. And how do we fund that? Well, largely through selling down some of our property assets. Again, I'll come on to that, but property assets are an asset class that doesn't benefit from rates staying high for longer, and hence we switched a little bit of that into sort of higher quality and higher growth assets that we've mentioned. Moving across to the property fund, again, as I alluded to, a weaker month in terms of performance, off 2.5% in New Zealand, and actually we're off more than double that in Australia, or 5.6, the REIT fund or the REIT index over there, and again largely due to concerns that interest rates stay higher for longer, and that weighs on the sector in general. How do we do? Well, some of our out of index investments held up pretty well. Somerset and Channel Infrastructure were two of those, but unfortunately some of the Australian names got hit a bit, and that is what weighed down the performance of the fund. Looking to the chart on the right, I mean, for me, this is probably the key issue with the property sector in general. It's basically plotting the yield of the property sector versus the yield of investment grade, basically bonds. And as you'll see, historically, the sector has offered you a premium yield, and in the last couple of years, it hasn't. And that is why the sector has been out of favour. The good news is in that 2024, we actually moved back into offering a premium in terms of the dividend yield you receive from the property sector versus a 10-year bond. The thing to bear in mind going forward is if rates stay higher for longer, there is a reasonable amount of chance that we do get to see some dividend cuts in New Zealand in particular. So you need to be a little bit wary where you are, but I do think that the headwinds for the sector are now behind us. What did that lead us to do in the month? Well, we basically put a little bit more of our fund into the higher quality side of the sector. So we bought a bit of Goodman Group back and, as I say, invested in channel infrastructure, high quality infrastructure assets, and funded this from those stocks which are more exposed to rates staying higher for longer. And we think that going forward, the outlook for the sector is probably improving. And I suppose that's the theme for 2025, is trying to avoid those stocks that do run a risk of cutting dividends. Well, thank you for your interest and support. If you have any questions about what we've been talking about, please drop us an email to info@mintasset.co.nz or phone us on 0800 646 833. Again, we appreciate your support. All the best for 2025, and we will speak again in February.